Everyone heard that? New corporate name for GameStop. Now the company's called Game Over. That's a joke for my friend. That's a joke for my friend David. I can't steal that, but I laugh so hard. Anyway, it is 4 o'clock. So Steve, you want to take over and do your thing? Is he coming in through Mark?
No, Steve should be.
Okay. Well, he's seen all the topics, so I want to kind of, does anyone have any questions in the meantime? I mean, he'll be, I'm sure. Anybody have anything they want to talk about in the meantime? I hope you have questions for Steve. You know, you saw my notes this morning. Those are things I want to talk about. They're not necessarily things he's going to talk about or you all want to talk about. That's fine. We're happy to talk about anything. We've got some Wall Street pros on along with Steve today, which is interesting. A couple of guys I worked with back in the 80s and 90s at Drexel and Jeffries. So we've got a little bit of a different crew today. There's just so much information today that, you know, I think the fervor for GameStop is, and these other stocks. I mean, you know, you've heard the expression FANG stocks. Then we had the BANG stocks. So that was BlackBerry, AMC, Nokia, and GameStop, and we'll see how long-lived that is. But I think, oh, here he is.
I'm here.
I'm sorry, that wasn't Steve.
No, Steve is here. Steve is
Oh,
here. I see him.
All right. So anyway, without further ado, we have a very special guest today, Steve Weiss from Short Hills Capital and CNBC. And I think we're just going to turn it over to him, and he's going to talk about whatever he wants to talk about. If you have questions, put them in or comments, put them in the chat room. Remember, anything we say on this call is for education and informational purposes. We're not trying to make you go out and buy or sell anything. Just one thing about the market, we're all on our own. I'm on my own. Arcadie's on his. Everybody's on their own. So the decisions you make are yours. And this is supposed to just make us all of us, myself included, more financially literate and more able to make the right decisions for both the short and the long term. With that, Steve Weiss.
Thank you. So good to see you all. Thank you for participating. It's an honor to do this, and it's fun for me. Why don't we dig right in, since there's so much that's topical, and let's start with GameStop. We're seeing the social movement is coming to a quick end, and the headline's kind of interesting. I'll just give you a little background on it. I invested for clients, particularly David Tepper's personal capital, in hedge funds. And one of the funds I invested in, and this is back in 2014, had a very large position in GameStop they built. And I said, what's the position? You know, what's the basis for it, your investment case? Said major cash flow generators on a free cash flow basis, on discounted cash flow, extremely cheap. I said, but their business model is going to hell. Everything's going online. And it wasn't too long after that the company, the management, was caught because their story was, look, we sell used games, huge market, big margins in used games. But it wasn't too long after that they were caught taking the wrapper off new games and putting them on the old games rack so they could show more sales in the old games. So they were actually losing money on it, but that was part of their story that got it going. That management's not there any longer, but the story, the troubled story still exists. And so they've been bopping along the bottom on life support for a long time. So I said to the manager, I said, I just can't. The other investment he had was in Range Resources. And he added to it at $100. Range Resources got down to $2 not that long ago. And I said, what are you doing? Oil keeps going down. And he kept saying, well, but oil only has to be at $70. Then oil only has to be at 60. Then oil only has to be at 50. So the point is that hope is not an investment strategy. You've got to deal with the fundamentals. You got to detach yourself from the emotion of it and step back. It's very difficult to do sometimes. I find I sometimes have the issue. I tend to talk to a lot of managements. I operate under the thesis that all managements lie. It's a natural bias that they have of optimism and a bias towards their company. And that's fine. It's not a malicious lie, although some do that too, as well as Gamestop. But when you talk to management, you can get caught up in what they do. So you really, particularly when you own the stock for a long time, you can really get caught up in it. So you want to step back. You want to take the emotion out of it, both when it's going high and when it's going low. So go back to GameStop, go back to Range Resources. If that manager stepped back, I took all our capital out of it. Others followed suit. The manager no longer exists, and he had a great track record up to that point. But he, as the saying goes, he couldn't see the forest through the trees, and the stories were not what he thought they were. So if he had looked at it carefully, I think he would have sold the shares. Not in retrospect, but then. Now fast forward. Now GameStop is supposedly sticking it to the man, sticking to the hedge funds. Well, there couldn't be anything more ridiculous than that. Sure, you had one hedge fund, Melvin Capital, that was down 53%. You had others that were down also because they were shorted. The mistake in shorting it was that it was a very crowded short. They also had puts. I believe they also sold naked calls against it. The liability is incredible. And in terms of what the risk management, risk loss is in the portfolio. And they suffered. So crowded shorts are never a good idea, but hedge funds get so big and they say that size is the enemy of performance. They get so big that in order to justify their 2 and 20 fees or whatever they are, they've got to have a short book. Some of them are doing it with ETFs, so they don't have the single stock risk. Some are still doing single stock, but in bigger names. Some spread those names over. One manager I know has 200 shorts. To me, that's not bringing value, because how could you possibly know the 200 shorts, the fundamentals, as well as knowing your longs? Whereas if you're a long-only manager, an alternative fund manager, like a hedge fund that's a long-only product, your fees are typically 20% above a bogey. And that bogey may be an 8% hurdle, but typically it's the S&P performance. So only if you outperform the S&P will you get that incentive. So GameStop was trouble to begin with, and it turned into a feeding frenzy. And they say this is great because it's the democratization of investment. It opens up to everybody. Robinhood didn't do that. John Bogle did that at Vanguard with passive investing, with index investing. And then it happened with Schwab going to commission fee trading and no fees on ETFs. Robinhood got there with what's turned out to be a very flawed business plan. What they do is where they make their money is they sell your flow. So when you come in to sell a stock or buy a stock, they're selling that flow, those trades, to Citadel or somebody else. And Citadel has the other side. They're working on the spread between the buy and the sell, the bid and the offer. And so that's not in your best interest because you're not getting best execution. So the point is, in investing, there's never anything that's free. Everything costs your money. You may not see it. It may be hidden, but it's not free. So that's the first thing. And in life, anybody says to you, this is free, then you got to say, okay, let me figure out what this is really costing me. But in investing, it's very easy to see. So GameStop, it was down again today. I was actually, as a lark, bought the March 19, 20 puts because I thought it would get there by March 19th. And I got rid of them just because it was a distraction. And that's the other thing I point out. When you do these things, say, I'm going to take a bet on this, I'm going to take a bet on that. It's a distraction from what you should be doing, which is focusing on the stocks you really care about. So, I'm on CNBC. We tend to talk about a lot of stocks. Jim Cramer on his show talks about 100 stocks a day. I will tell you that Jim's a smart guy. I knew him when he was a hedge fund manager. I was an institutional salesperson, actually covered him for a little bit. There's no way Jim could know 100 stocks. So whoever, that's actually a Robinhood trader in the background. So you really have to be careful about who you listen to. You have to do your own work. And it's difficult to do your own work because you don't necessarily have resources. But I guarantee it's a UPS truck going by. But I also know hedge fund managers that refuse to talk to companies, that just do it from the public filings. Maybe they have other resources like data scraping resources. But the point is, even as students, even as individuals not involved in the market, you can do your own work on it. And there are always, the chat rooms will give you information. Chances are it's people talking their own book. But I'd stay away from the hot ideas, because you read about somebody who made $1 billion on this. The trader who sat in their basement made $500 million on this. It's all ridiculous. And number one, a lot of it's not true. And number two, right place, right time for a lot of them. In fact, the person who started Gamestop had started the frenzy of Gamestop and been lugging around the position for 2 years. And he bought it as a value play. He didn't buy it to stick it to the man or to go after hedge funds. That's lunacy. So, so they say it was a social movement. No offense, but I've seen bowel movements last longer for my kids when they were young and ate the wrong thing. So let's move on from GameStop. It's ridiculous. If anybody has any topics they want to talk about, just throw them out. But I'll move on to a couple of things. I want to talk about index investing for a minute. And index investing, I used to run a fund, and what we did in the fund strategy was that when companies get acquired and they get acquired for less than they're worth, you have the right to petition the court in relevant jurisdiction, vote against the merger, and say, this was an unfair process. They bought the company for less than it was worth. I want to petition for fair value. And fair value would typically be done on a discounted cash flow mechanism. So we sued companies in Delaware. We sued companies in the Cayman Islands. And you may ask, why would a company sell itself for less than it's worth? I'll give you a story. We sued Panera. Panera sold the company for almost $8 billion. We thought it was worth $13 billion. Big difference. The reason why they sold it for less than it's worth is that right after the deal closed, Ron Shaich, who you may see come on CNBC and wax poetically about corporate governance, received $800 million in stock from JAB, the acquirer, after the deal closed, which he promptly sold. So he took the $800 million so that JAB didn't have to spend an extra $3 billion. So that's why they do it. We didn't win the case. We didn't lose it, but we didn't win it because the Delaware courts don't really care about shareholders' rights that much anymore, because the massive lobbying group, the U.S. Chamber of Commerce, which is not a public agency, it's a lobbying group, said to Delaware, if you keep giving these kind of judgments to shareholders, we're going to tell our constituents to domicile outside of Delaware. Now, the reason I'm bringing this up is because you've got the index funds, the BlackRock, and Larry Fink writes his letter. We want companies to do this. We want companies to do that. Guess what? They don't have to listen. Larry Fink has to own those stocks. BlackRock could have 20,000 positions. They've got 40 people or 45 people in their ESG department, of which half are administrative. How can they possibly follow 20,000 stocks? They can't. So as shareholders, you're on your own to protect your rights. Nobody's doing it for you. And that goes under the entire market. As John said when he started, we're all alone out here. Every person for themselves. There's nobody that's watching your back. The SEC is not doing it. Insider trading is alive and well. I own a company called Corvo. And Corvo makes chips. They're in your iPhone. Phenomenal story. The tech tape was pretty strong the last couple of days. And Corvo traded down meaningfully. Right after another company I own, Skyworks, had a phenomenal quarter. And the stock went from about 160 to 190 based on their quarter. But Corvo, which has parts of the same business, kept trading down into the earnings. And I said to another manager, I said, they're going to miss. Somebody's trading on this information. They know what the quarter's going to be. Sure enough, while they reported a good quarter, some of the commentary was negative. So the stock was down at 1 point, 10% yesterday. I bought more. It closed the day maybe down 4%. Not a big deal. But insider trading exists. The SEC really doesn't do much about it. There's another situation where I had breakfast with one of the SEC commissioners last year, and before COVID, when you could do that kind of thing. And I talked about insider trading, and I gave him two examples. One was a company called Instructure, where the CEO and a board member who had never made an open market purchase before went out and bought stock. And the next week, not 5 days later, the company was acquired. And I said to Commissioner Jackson, I said, and I gave him another instance, and I said, you know, what story? You know, he said, well, file a whistleblower suit, but let me tell you what's going to happen. He said, when I was a professor at NYU and a lawyer, I found 800 instances because from the 5-day period from when a deal is agreed to when it has to be announced, I found 800 instances of insider trading. I put it on a website. I spoke to the SEC. He said they pursued one. Now, why is that? Such obvious cases. There's another case I told him about when a company was being acquired, rumored to be acquired. The stock trades 53. The CEO sold stock and 2 days later announces a deal for 47. He said that the lawyers just keep papering it over, filing motion after motion. And then the SEC people turn over, they leave, go to law firms, whatever they do, and they just don't pursue them. So you'll see one headline case where maybe they pursue it to try to scare people, but people figure the odds are of succeeding as a criminal insider trading are very high. So if you have those bones in your body where you want to do that, you know, go ahead, but you don't have my endorsement. So that goes back into John's point that you're completely on your own. I'm not going to say the markets are rigged. They're rigged for whether you've got $5 in the market or you've got $100 in the market. Basically, over time, they bear out and they're solid investments if you take a long-term view. To try and day trade, and I worked for Steve Cohen, I ran SAC Capital before it was 0.72. I was chief investment officer there. Steve can day trade, even though he doesn't do it now because he can't do it. It's very difficult to do it now. A few others, but 95%, and I'm being generous because I think the number's more of all day traders fail. You just can't guess what the market's going to be doing with all the different strategies in there. So you really want to be a long-term investor and concentrate your portfolios in a small number of names. Diversification is also the enemy of performance. So it's, to me, that's the winning strategy that you want to do. We talk about Amazon as well. I own Amazon, I've owned it for a while, and Jeff Bezos stepping down. Stock didn't flinch. And the reason why it didn't flinch is because number one, he's not leaving the company. Number two, he owns a lot of stock. There's no chance of him divorcing himself from the company or being able to sell enough stock where he's willing to trust somebody else. Now, the growth in Amazon, the profitable growth, has been in AWS, Amazon Web Services, the cloud, where they lead. And the person who's running it got to Amazon 2 years after Bezos founded it. And he's going to be running it. And so to me, that was the best choice, a much better choice, frankly, than what we saw when Bill Gates stepped down and Steve came in, bomber. He didn't do as good a job. But they're great businesses. I don't really see Amazon missing a beat. There's talk about splitting the shares, not from Amazon, which to me is, as I was asked the question, I said, it's really an inane conversation. Because if you buy 10 shares of $100 stock or 1 share of $1,000 stock, your returns are the same. It doesn't matter. Number one. Number two, well, you can't afford to even buy 1 share of Amazon. You can buy fractional shares through so many brokers now that you don't need to split it. So I wouldn't look, I wouldn't count on splitting the stock. Stocks don't normally go up after you split them. Sometimes they do, sometimes they don't. It's short-term pop. If it does, it's about 8% within 6 months, I believe. I'll tell you when a stock reverse splits, because it's a dollar stock. They want to make it a $5 stock so that you can margin it. Those stocks typically go down. I've never seen a good story with a reverse split. That's usually a sign of trouble.
Steve, can I ask you about Amazon a second?
Sure.
Yeah. I saw something, I think last night somewhere, talking about them having to appear before Congress for some hearings, in terms of big tech being broken up. And the point was that Andrew Jassy will be a much better witness than Jeff Bezos would have in front of Congress. He doesn't come, he's not the world's richest man. He doesn't have the same arrogance, let's say, that Bezos might have. And he'll make a better witness for the company as the representative in that setting. Do you think that played into the timing of this?
Not at all.
No?
No, sorry, but not really in the least. It's going to be very difficult to break up these companies. Do you want to be the congressman going to your district or congresswoman going to your district and say, I'm the one who broke up Amazon, so now you got to go back to the store, or now you've got to pay 20% more than what you were paying before? I don't think so. Now, it's not just Amazon, of course. It's Alphabet, Google, it's Facebook, it's even Apple. On each of those companies, the sum of the parts are greater than the whole. So if you want to break up Google, go ahead. I'd rather have each of the parts. You want to break up Facebook, go ahead. But there's not really antitrust there, I don't think. Now, that's my view. Obviously, the government thinks different, but this will take years and years to work out. And you don't have bipartisan support for investigating them on an antitrust basis. We'll see if you get bipartisan support to enact laws to change it. I just don't think so. Now, that's different than will there be an overhang on the shares, particularly as you get into the hearings and other things, possibly. But at this point, it's not news to anybody. They're going to be investigated. There'll be hearings, and the hearings are really grandstand. They don't really, and everybody knows it. If they really want to get something done, have closed door hearings. Don't have the open hearings. So I don't know if Jassy will be a good witness or not. Bezos is still executive chairman. They could still subpoena him. He still started the company, founded it, and created it. Amazon's not going to dictate who the witness is. The government's going to dictate it. So I don't think anything's going to change there.
All right.
Any other questions, or do you want me to keep going down?
Well, just a comment on when these companies get broken up, if they do or not. You old, when your parents, everybody owned telephone, and in '84 they broke telephone up into 7 parts. And to Steve's point, you did very well if you just held on to those things for a few years. So I believe also with Steve that if this happens, it would be great for all of us.
Right. And I was a tax attorney at that time and actually worked on the breakup into the baby bells. So it was kind of an interesting time. Let's talk about, there's also a fascination with leisure stocks or reopening plays like the airlines. You may wonder why the airlines you may own them, you may have bought them, say they're going to do great when the economy opens up again. I would tell you that they may do well in terms of bringing passengers on. After 9/11, it took 3 years to get back to the normal traffic loads, number one. Number two, if you're an equity shareholder, you've been so diluted by the shares, by the capital raises they've had, more shares, more debt. That debt service is going to happen. So you take a look at a stock like, I'm gonna look at Delta here. Or I'll tell you what, I'll look at United Airlines because we're right by the hub. So United Airlines peaked at $90, roughly $90 a share for a nanosecond back in February before all this happened. The stock got down to 30 to 21, and now it's trading at 42. I would tell you that given the balance sheet right now, because it's upside down financially, the airlines are, the cruise ships are, meaning that they're just got so much debt that they've got to service. And traffic's not going to come back that quickly. It's definitely not coming back this year. It may not come back next year. And they have unions and lots of obligations, lease obligations, et cetera, that I would tell you that United Airlines over the next year is fairly valued 42. Maybe it shouldn't have been at 20. Maybe it shouldn't have been at 90, as a matter of fact, but it definitely shouldn't be at 42 now with everything the company's gone through. You have the cruise ships, which aren't putting any boats in the water with passengers, and they have also massive CapEx, and they've just diluted themselves, to the moon with piling on billions and billions of debt. But yet there's this fascination with these reopening plays. Now, excitement and momentum overcomes fundamental analysis sometimes, and that may be the case here. But I used to own United, I used to own American, and I owned American a number of years ago when it went into bankruptcy. And I bought it at 2, I bought it at 5, and I bought it at 7. It was actually in bankruptcy. But you could do the analysis that the parts were there, that it was worth something. Here, you really can't do that analysis because you just don't know when they'll be back at full loads again or close to full loads again. So they're difficult stocks to own. They were part of the squeeze play because they're heavily shorted. I mean, who wouldn't be short these things? But I own a stock. I own a couple of stocks that have heavy short positions. One is called Vuzix, V-U-Z-I. And if you remember the Google glasses, they actually make functional Google glasses. And more of the float is short than it is, than there's actual float. Now, when the government wants you to find a locate when you're shorting stock, meaning that you have to actually find shares that somebody's going to lend to you in order to short it. If you can't find them, then you can't short it. So the stories about GameStop being 240% short of the float, I just don't believe them. However, on this one, you can have that. And I'm saying the float because the insiders own a bunch of stock. Then there are others that have been associated with the company or investors they've known for a long time that lock up the stock. So even though the stated short interest is maybe 20% or 30%, at one point it was 40%. But it's a good fundamental story. And I don't get scared by high short interest when I own a stock. I like to see it because ultimately they're going to have to cover. Now, Vuzix has no earnings. In fairness, I bought the stock at $3.50. I think it's about $12 today. But they've just continued to come out with these announcements. For example, it's $12.42. So, for example, knee surgeries are very difficult, knee replacement. And they make these glasses that the surgeon, the orthopedic surgeon, takes into the operating room, and a schematic of how he's going to replace the knee appears in the glass that he can follow point by point. So the replacement is perfect. It's approved in Europe. They've done over 40 operations. It'll be approved here. For the other things they're doing, you may have heard of Plug Power. So Plug Power, they've got to deal with, where for employees that are training, rather than sitting in a classroom training and going through the manual, they'll be in the field and the manual will appear in the corner of the glass. So they can actually be doing true on-the-job training. And they've got tons of other uses for it as well. So the short interest is very high. The short interest is high because the company doesn't make much money, even though revenues doubled year over year, up 100%. And I believe they'll double again for this quarter. So they take a look at that and they say, whoa, this stock's gone too far. It's too high. Valuation is always a bad reason to short. I can't tell you how many people were carried out in stretchers because they shorted Amazon in the early days because they thought it was overvalued. To short, you need a catalyst, an identifiable catalyst, and you need to know the time that it's going to occur. Otherwise, you'll just lose money. So I mention this because getting back to the short interest, it can be beneficial to have high shortages, particularly if you've got conviction that the story is solid. They don't know what they're talking about, because that's another marginal buyer to come into the stock. What else do you want to talk about? Any other topics, or you want me to go through the?
So, does anyone have any questions? What do the people want to talk about? I mean, we'll talk about anything. Obviously, Steve will talk about anything. So what's on
Right.
your minds?
Well, I'd like to make it, whatever, if anybody's got a question or.
Case, what do you want to talk about, Case? SPCE or the sector or what?
Yeah, how you doing? How you doing, Stephen? Do you have any thoughts on Virgin Galactic with their rescheduled flight for the 13th of this month? Any
For the
thoughts on
space
Virgin
flight?
Galactic?
Yeah, so.
Yeah, it was rescheduled to.
Yeah, so that's another one. So have you heard of Kathy Wood from ARK Investments?
Yeah, yeah.
Okay.
Kathy was.
So I know Kathy. She's a brilliant investor. She put out a book on disruptive investments, 120-page or so pitch book, which can't believe I haven't gone through. But I can send it to you, John. You can send it out if you
We've
want.
already read it.
Yeah, okay.
We love Kathy. We love Kathy.
Yeah, I like it. Has she talked to you guys yet?
That'd be great. No, she
Yeah.
has.
I mean, I think she's kind of busy, but yeah, I know Kathy, and she is great. As soon as she came out and mentioned that she was going to launch an ETF, a space ETF, I immediately bought the stocks. I bought SPCE. That's what I bought, and I sold it pretty quickly too because it popped. I just happened to be in front of here when a sales guy from Morgan Stanley just hit me on it and said, "Okay, I'm going to do it." Look. It's, I know Chamath, who's also obviously involved in the space, and Chamath is great at preaching and, saying everything that sounds right, socially forward, but a large part of him is full of crap. Yeah, I mean, he's talking his own book. So the space, it's a SPAC. I think it's okay because there's so much interest in it. It's far enough out where they don't really have to deliver. I don't know how big the audience is. When you think about it, it's very expensive to fly into space. You've got Bezos, who's going to focus on that. You've got Elon Musk, who's brilliant business person and done a good job. But it's a lot of it's hype right now. So I'm not involved in it. Because there's no way for me to analyze it. It's really a hope and a prayer right now. My biggest theme is 5G. And to me, the street is completely missing it. Analysts are missing it. Citi downgraded Qualcomm today because they said the 5G cycle's over. Like I said on the air today, that's asinine. These cycles go 10 years. 4G was 10 years. If you invested in 4G stocks, 4G semi stocks and some others, over that 10-year period, you are up 450% versus NASDAQ up 310% and the S&P up 190%. And here's why it's different this time. And I apologize for throwing that out, but it's always different. Some people say, oh, it's never different anytime. It's always different for certain reasons. So here's why it's different this time. Whereas 4G and 3G, 2G were mobile-only networks, 5G is a platform-enabling technology. So 5G is not just about phones. As a matter of fact, I could care less about the consumer end of it. 5G is up to 100 times faster. The bandwidth is up to 1,000 times greater. Latency is less than 1 millisecond. The clarity of the picture is unbelievable. And the network's always on. Oh, in addition, it uses 90% less energy. So what does this mean? So it means that you can have remote surgery. So China, which is further advanced than us in laying out their 5G network, has been doing brain surgery with the patient 1,800 miles away from the doctor. Now, why can you do that with 5G and not 4G? Because the network's 100% reliable, because the delay is less than 1 millisecond, because the picture has perfect clarity. Before COVID, Nokia started a joint venture with Lufthansa Technik. Lufthansa Technik, if you're Delta Airlines and you've got an engine that needs to be repaired, you send it to Hamburg, Germany, to Lufthansa. But before they would release it to you, you had to send your engineer from Atlanta, where Delta is, to Hamburg to inspect it. With 5G, again, before COVID, this was last year, November, they put in a private 5G network where that engineer can remote in from his office in Delta to Hamburg, Germany, and inspect it on the shop floor. So never has to leave the office. Saves 2 days in traveling, saves a day there. That's 5G. Pirelli's already invented the Cyber Tire. And what the Cyber Tire does is it's a chip in a tire, a 5G chip, and it reads the road, whether there's hydroplaning, whether there's ice, whether there's potholes, whether there's traffic, and will send that signal along the 5G network to other cars to automatically avoid it. More than half your NFL stadiums have private 5G networks. So the reason why this analyst missed it is, number one, it's a 10-year cycle. That's just fact, even though they're already working with 6G. But because the total addressable market, the TAM, has increased exponentially. So if you take Skyworks, that 3 years ago, 100% of their revenues came from smartphones. Apple this quarter was the biggest customer and has been, with 70% of revenues. Now, 30% of their business comes from outside the smartphone. If you've ever ridden a Peloton, it's got a Qualcomm chip and a Skyworks chip. Your cars, Ford came out and said, hey, we're cutting production of the F-150 because they've got semiconductor chips in it. The Vuzix glasses, you go back to the Vuzix glasses, they're 5G glasses. EMTs will wear 5G glasses, and they'll have a transponder. They're doing this with Verizon on top of the ambulance. And the EMT, the tech, will have these Vuzix glasses, be looking at the patient. That image will go to the doctor sitting in the ER, telling the EMT what to do. Now, EMTs can't operate, they can't do much, but in terms of what they can do, how to prep the patient for coming into the hospital. So for disasters, where doctors are there. So that's what 5G can do, and 1,000 other things. And that's what everybody's missing on 5G. And that's why I think 5G will be, frankly, in 30 plus years, one of the best investment themes I've ever seen. So the uses are just unbelievable. Every industry, is trying. And most don't know. So
Why do you think Wall Street's missing it?
Well, for a few reasons. Number one, they look myopically. So when you're talking to a semiconductor analyst, that semiconductor analyst is just looking at that group of companies, and they're not doing the work. They're lazy. I mean, I ran a global research department at Silberman Brothers, and I ran a research department at Healthcare Investment Bank. I can tell you that yet 80% of their job is marketing. 10% of their job is doing research, and 10% of their job is figuring out how to get out of the office early without telling anybody. So I don't know why they're missing it. Not all of them are missing it, but most are. The city analyst definitely is missing it. But 5G is just a phenomenal opportunity. All you have to do is talk to the companies.
So
All you have to do, I mean, Qualcomm says it's a $13 trillion opportunity by 2035. Nokia says it's $8 trillion opportunity.
So when you say 5G, if you can hear me, does that suggest maybe an ETF, a 5G ETF?
Well, I actually looked at doing one, but there are a couple out there. There are 3 of them out there. One is FIVG, and the other one is NEXG, I think. I wouldn't buy them. I mean, they're better than nothing, but they, I've been doing the work on 5G for 4 years now. Those ETFs have between 75 and 100 names. And I will tell you that there aren't 75 to 100 names where they have material exposure to 5G. So they're doing just sell product. They didn't go out and do bottoms up research on it. They hired companies to, figure out which are 5G by going through annual reports or, Qs and seeing if 5G was mentioned. That's not doing analysis. Versus the SMH index, the ETF has about 22 names in it. So they're the only ones that are out there right now. I think you want to buy the chips, but not everybody participated equally. When I invest, I want to own the companies that are the beneficiaries of CapEx, not the ones that deploy it. So if you look at the 4G cycle, the telcos, which are the big spenders of CapEx, underperformed the semis by about 1,000 basis points over the 10 years. So you got to be careful who you own. Not all of them do it. I used to own the tower companies like Crown Castle, but don't own them anymore. They were good stocks, but they're limited in terms of the upside.
So you mentioned Qualcomm and you mentioned Nokia. Those are the big ones?
No, I wouldn't own Nokia. I own Ericsson.
No, I wasn't asking what you own. I'm just kind of asking which are the big ones in the 5G arena.
Skyworks, Qualcomm, Qorvo. Analog devices with cars. I mean, you can't have autonomous driving without 5G, right? Because you need the quick reaction, lightning reaction. You need the always-on network for autonomous. So there are a number of different companies that are involved in it. Micron, eventually it'll be more in the 5G space. They're a little bit in it now. Marvel. I own Inphi, which got acquired by Marvel.
So you buy a little bit of each and hope that one of them takes off like Amazon.
Well, you're not going to see an Amazon-like performance because you have metrics to measure it against, right? Amazon, you're always measuring against the execution of the vision, right? There's no valuation metric to it. And there's somewhat of it now, but yeah, I mean, they'll do well. I mean, Skyworks is more than doubled, since the lows in March.
But Ron, just to interrupt for a second. So the thing that Steve's pointing out, the most important thing he's pointing out, this is thematic, right?
Exactly.
So we've done a lot of work on 5G, and you've asked him for specific companies. He's given you a few, but it's the theme and the TAM, which is so important here. So and he pointed out Kathy Wood's this long research report, which is amazing because it doesn't talk about stocks, it talks about themes. And when you think about the next 10, 20 years, 5G, you could throw a dart and buy 10 of them, or you could buy the best 3. But if the theme's right, you win. And
that's what I was asking for, an ETF.
Right.
Yeah, but then the key is, and as Steve points out, when these like iShares puts together an ETF, they're not doing the research on it. They're like going into Moody's and going, okay, give me 50 stocks that say 5G next to them. That's the problem. When Steve's doing deep research, it's game changing. And in terms of, you'll probably get fine performance in the ETFs,
Yep.
But if you want better than market performance, then you got to dig a little deeper and go, okay, Qorvo or Qualcomm or whatever. And that's the difference. So when you take single stock risk, you're taking more risk, but the reward can be so much more. And when you're a research guy, which everyone in this call should be learning from Steve, that you need to do your own research. You can't rely on somebody else. So when Steve says, look at Qorvo, that's the first thing after this call. I've never even heard of the company. I'm going to go take a look at it and go, huh, right? And have that aha moment. Where do I want to add this to my portfolio? And that's when you want to become a better than S&P like investor, this is how you have to do it. And there's Casey points out the ticker, QRVO.
Yeah, so Qorvo, so what they do is it's a $20 billion market cap company. What they do is they make the chips. So they're RF chips. They have other businesses. And what RF chips are is they're basically power regulators. So they bring in the signal and then they disperse the power into the phone in terms of what function's being used. As phones get more advanced, they need more complicated. They need more RF chips. So whereas the prior iPhones may have had 1 or 2 chips from Skyworks, and Skyworks dollar content per iPhone was $9, with 5G phones, that dollar content can go up to $20 because now they need 5 or 6 of these antennas, for want of a better word. And so think of that. So I started talking about XPO Logistics, another company I own. You may see their trucks on the road. I was talking to the chief strategist. I was on air and the management missed the earnings, their own guidance, for the 4th time in a row. And I said, I'm thinking of selling the stock. How can you miss your own guidance 4 times in a row, right? You're telling us what you're going to earn. You don't have the insight into your business that you should as managers. So they immediately reached out to me and said, we want to talk to you. So I spoke to this chief strategist and I said, I wound up buying more stock because I thought they were getting it together. And I said, what are you doing in 5G? And he said, I'm not aware we're doing anything. And I said, I guarantee you're doing something in 5G. Could you find out? I said, I'll talk to our IT people. He came back and he said, every one of our facilities is being upgraded to 5G. So that's why analysts don't know. Mercedes, if you go on Mercedes on the web and you just Google Mercedes 5G factory, you'll see they're building an entire factory that'll be run by 5G. No people really, just 5G. So that's why people just aren't doing the work. They stay on the surface and they're just creatures of their old habits. So, but that creates opportunity, right? So, like today, or I was watching Corvo, they reported last night, stock was down $16. I added to it, closed down 8 today. But too many people associate volatility with risk because stock goes up and down. To me, volatility is opportunity. If a stock trades up too much, I can shave a little bit if I'm willing to pay the taxes, if it's in a taxable account. Most of the time, I don't want to do that because if I take profits, I've got to pay 50% in taxes, right? So I got to believe the stock's going to go down 50%. So when strategists and analysts come out and say, hey, I think the market's going to be rough, it's going to be down 5 or 10%, maybe take some off the table, it's just idiotic advice because you got to pay taxes on that. You're only going to buy it back. Markets go up 90% of the time. So you got to be able to tolerate the volatility. Always keep a little cash because when they sell off, you want to be able to get in and to add. So I like volatility. I think it's great because it's it's opportunity to add or take off.
Steve, we had a question from the field. Can you talk or give us your opinion on Bitcoin?
Yeah, sure I can. I'm not a believer. Elon Musk came out and tweeted, had a Bitcoin on his, on his Twitter page, and now he's doing Dogecoin or whatever. He's just messing with you. I don't know if he owns any Bitcoin or not. Chamath talking his own book, pushing Bitcoin. It's illusory. It's not a currency. It doesn't mean it's not going to go up. I actually own some through a Robinhood account, believe it or not. And the execution was so bad. I wired money, it took 15 days for the wire to hit. Wire should hit the same day if you do it early in the morning or at the latest if you do it after 3 the next day. But Robinhood, again, free because they don't charge any fees for buying Bitcoin versus PayPal, which is like 5%. Robinhood worked on my float of what I wired. So they're not free. I didn't get that interest, even though it's meager. They got it, right? So anyway, so then I bought Bitcoin and just to have it. I haven't even looked at the account since I bought it, to be honest. But when a currency could go up and down, literally 10% a day, or in one case, 2 weeks ago, dropped by 20%, you can't use it to buy anything. It's not a currency, right? So can you walk into a store, can you buy it, or you go to a car dealer, right? There's one car dealer in California a few years ago who said, I'll take Bitcoin. Okay, so your Bitcoin's worth $30,000. Say you buy a $30,000 car. By the time you get done signing that purchase agreement, Bitcoin's dropped to 20,000. So is the dealer going to bear that brunt? No. So that's why it's not a currency. Plus, it's not supported by the government. You know, I want the full faith and credit of the US government backing up my currency. So I just don't see it with Bitcoin. Maybe eventually, you got a lot of smart people involved in it. You know, so I own it just because I think the momentum's there and we'll get it higher. But, you know, I don't know what it stands for. You know, so they're pushing it as a currency, a digital currency. And
Is
PayPal said, oh, we'll let you start transacting on it. You
it is
know,
not currency for tax purposes. It's property.
what's the value backing it up? More Bitcoins? The pitch on Bitcoin is, by the way, it will be a currency, not that it's property.
But yeah, but for tax purposes, it is property.
Right.
So if you bought it for 100 and it goes up to 300 and you use it to buy something, you actually consider to have sold what you used to buy something and have to deal with a gain on the $200 for
Right.
tax purposes.
Right. I mean, well, frankly, the same thing. You know, if you buy a stock at $1 and it goes to $30 and you donate it to a charity, you get it right off for $30.
Right.
Right.
Mm-hmm.
So it's, but I just don't see it. I think it's highly speculative. Look, just as a rule of thumb, if you want to have 10% of your portfolio in speculative assets, it's fine. But if you do more than that, then you may get lucky, but then you're really cutting into what you could use to grow, and creating wealth is all about compounding, right? It's year after year after year. You can't compound if you're paying taxes and selling and trading around it. It's very, very difficult. And for Bitcoin, you know, it has been hacked, right? You don't hear about all the hackings, but it has been hacked. And you have Gary Gensler, who's will be the new SEC chairman, who taught a course on it at NYU. And they're thinking, oh, maybe he's more disposed to it. I'm not so sure. I'm not so sure he's a believer in it. So that's what you would need. So I'm not a big proponent of Bitcoin at all.
Any thoughts on Mark Cuban?
So I know Mark. We exchange ideas, mostly him telling me. I think it was beyond the pale that he came out and said, hold it. Like, what is he talking about? You know how many people have lost a fortune on GameStop now? More people have lost more money than have made, right? So for him to come out and say that, and then he tried to talk it back, walk it back, it was ridiculous. Mark's got a, nice guy, very nice guy, very big ego. I don't think he's ever been wrong. Yeah.
Here's another question. So Robinhood, I know people in the group have accounts there. Company was valued at $11 billion last week. They drew down some of their credit line. In 6 months, in your opinion, what's Robinhood worth?
Mm-hmm.
Is it its own company? What happens?
To me, Robinhood is a marketing scheme. You get so much more from trading commission-free at Schwab or Fidelity or any of the other brokers. And the issue with Robinhood is that they're capital constrained, meaning that they didn't have enough money. When they came back and they said, hey, we're not going to allow you to trade more than one share of GameStop, or you can't trade any of it. It wasn't a conspiracy. Hedge funds didn't put them up to it. Hedge funds love, not that you are, dumb money, right? Just love it, So the more people come into the market, the better. It gives them more liquidity also. It's because they didn't have the capital. So they've got to clear their trades through DTC, which is a central clearing organization for all trades, right? It's centralized, so they match buyers and sellers. And Robinhood, you have to put there are margin requirements, for want of a better term, and you've got to put up those capital requirements in order to clear your trades. If you don't have the proper capital, then DTC won't allow you to trade because you can't meet your counterparty risk. So that's what happened. So then all the investors that have staked Robinhood, and keep in mind, this isn't their only investment, right? They've got Silver Lake Capital. They've got hundreds of investments. And the way private equity and VC firms work is that out of 100, 90 fail and 10 hit it really big. So I don't know where Robinhood will be. I suspect they'll survive, but I know that I want to be investing with a counterparty, right? That's well capitalized, and that's not Robinhood. That's Fidelity, that's Schwab, that's TD, Interactive Brokers, which isn't free for retail. But Robinhood offers me nothing. Maybe they got a cute logo, and SoFi also, with Chamath is taking, public in a SPAC. Anthony Noto is a friend of mine. He's the CEO of SoFi. He actually worked for me years and years ago. Very high quality individual, but they don't really have the capital for all the trading. Nobody's really trading through them now. It's a good company, but it's basically a loan book. So go where there's volume in trading. Go where they've had this reputation of quality for decades and decades. You got to be very aware of the cool factor, because odds are you're paying for the cool factor. It's the
Does
market.
everybody get that? Because that is the most important on you is when one of the Robinhood problems is if they can't settle trades, if their systems go down and you need to do something, you can't do it. And someone on the chat room goes, just go to Fidelity or Schwab. Fidelity and Schwab are great. Fidelity gives you free research from 10 different brokers. And then the commissions are free. Why would you use Robinhood? To Steve's point. But the whole thing about settlement, it's like this undercurrent in Wall Street that, we don't really care about when we're just buying and selling all day. But when your trades don't settle right, that's a problem. You go back to Bear Stearns going out of business. You go back to long-term capital for us oldsters, long-term capital going business when trades couldn't be settled. The system freezes. You younger kids have never seen that. That is a scary, scary thing.
You lose your money, basically. Your money, you're in there, like for Lehman. I left Lehman in 2002, or you have MKM Partners more recently. You'd say, oh, wow, MKM, great firm. John Corzine, who was the number 2 person at Goldman Sachs, was a senator in New Jersey, runs MKM Partners. If you hadn't counted MKM Partners, you didn't get $1 on dollar back. You lost your money. So you got to be very, very careful. It's called counterparty risk.
If you learn nothing today, the thematic stuff and this stuff is so incredibly important. And don't slough it off like, oh, Robinhood's great. It's not. It may be great if they get more capital, but you got to be as Steve said and I've said, you're on your own. Robinhood doesn't care about you or me.
No, and the company, it's not run by dyed-in-the-wool financial people, right? And that's the other thing. So they may not even have been aware of what the capital requirements would be, because when everything's going great, it's good, okay? But that's not what you got to worry about. You always got to go into any situation and say, what can go wrong here? Not what can go right here. What can go wrong? And so I wrote this book, The $1 Billion Mistake. And the reason I did, because I learned so much more from my missteps than I did from my successes. Success, that's great. And you go on, you're all happy and gleeful. But you dwell on your mistakes, and you should in investing, because that's where you learn the most. That's what you don't want to do again.
We have time for one more question. Somebody speak up.
I got one. Any opinion on the potential silver squeeze? I'm
Go
happy. Look, I consulted with a commodity hedge fund. Commodities are ruthless. You can't think of one oil trader, for example, that's been around, for a long time. Commodities are a very, very difficult market to analyze. So you may squeeze silver for a day. The Hunt brothers owned the Kansas City Chiefs way back, actually got indicted for, for squeezing silver, right? They were cornering the market and propping up the prices. I would stay away from commodities, pure and simple. The best eventually crash and burn without exception, because they require a lot of leverage. And if you're going to do it through an ETF, but you can go decades without making money in commodities. And I just don't believe investing in oil. Another theme I'm involved in is clean energy. I'm a firm believer in ESG. I think clean energy, and there are some good ETFs there. I think that is the wave of the future. More ESG funds have seen greater asset growth than any other group, any other investment strategy, period. It's about 40% of all assets worldwide, 25% in the US, and growing like crazy. So.
And to Steve's point, remember, you're on the board of Fairleigh Dickinson, you're putting money in the endowment. And the broker says, all right, are we going to buy ExxonMobil or a clean energy company? No one is going to buy ExxonMobil when you need to be ESG compliant.
Right.
It's so commonsensical, right? It's like, we all get that. That's why Exxon and Chevron tried to merge last year. The handwriting's on the wall for these legacy companies.
Right. So I own Brookfield Renewable Partners, got a nice yield. It's renewable energy. I own Vestas Wind Systems, a $50 billion Danish windmill maker nobody ever heard of. I own TPIC, which makes the windmill blades. I own AY, another renewable to Yieldco, big yield, outside the US. I mean, do your own work on those, but, I own ICLN, which is an ETF. So to me, you're both doing something good. You're reinforcing, good things for the environment. And I think you can make money. Biden is all over this, and he's really going to drive it.
Steve, thank you so much.
My pleasure.
That was great. I just want to shout out to Professor Lee for her great call last week on SAVA. I blew that one, but we'll see you all next week. That was great. And so Steve's in the email chain now, at least until he tells me to delete his name. So if you have questions or comments, shove it in there and he'll respond to you. Because,
We'd love to see more of you, Steve. We'd love to see more of you, Steve. Thank you so much. This is great.
Pleasure.
If you need a symbol or what he talked about, I'm sure he'll be happy to bring it up again. And if you're not in the email chain, give your email to Mary. It'll all get together. But this is not just an hour thing. This is a constant life learning process. And the more we hear from guys like Steve is great. And we all got to think it. We have to all think about this a little bit more than we do in a common sense fashion.
I'm still learning.
I'm still ditto, always.
Yep. All right. Thanks for bearing with me, everybody.
Thanks, Steve.
Okay.
Thanks, Steve.
Thank you.
Thanks, Steve.
Bye.
See you tomorrow on CNBC.
Thank you, Steve.
Next
Really
week.
appreciate it.